298.7 million barrels. That is the number of crude oil sitting in the United States Strategic Petroleum Reserve as of the second week of August, the level reported by the Department of Energy, after a release of just over 6 million barrels in a single week, pushed the reserve below 300 million barrels for the first time in more than 4 decades, to a mark not seen since 1983. If you are following the energy story at all right now, you are looking at the wrong chart. You are watching the Brent crude price tick around $88 on the day 2 more tankers were attacked near the Strait of Hormuz on the 14th of August. You are refreshing headlines about whether the United States will escalate economic pressure on Iran, about whether gasoline at the pump will jump another 40 cents, about naval escorts and insurance premiums and war risk surcharges. All of that is real, and all of it is downstream of something quieter. The number that changes everything is not the price of a barrel on the futures screen. It is the number of barrels the world has already spent from the one place designed to make a disruption survivable. 298.7 million barrels sitting in salt caverns along the American Gulf Coast and falling, while the world's most important oil artery is still running roughly a quarter below normal. That single figure should reframe every other energy headline you read this month. To understand why, you have to know where the number comes from and what it is supposed to do. The Strategic Petroleum Reserve was built in the 1970s as a direct answer to the 1973 embargo, when Arab producers cut off the United States and the Western world discovered how naked they were without a buffer. The logic was simple, and it has not changed. Hold enough crude in government-controlled storage that if the physical supply of oil were ever severed again, the country could draw down the reserve while diplomacy, military force, or a slow rerouting of trade did their work. At its peak, around 2010, the reserve held more than 700 million barrels, a cushion measured in months of import protection. Since then, it has been sold, drawn down, refilled partially, and debated endlessly in Washington. What matters for this moment is the trajectory. The reserve entered this decade in the high 600s, was deliberately drained by releases in 2022 to fight the price spike that followed the invasion of Ukraine, and was partially rebuilt. Even near the end of 2025, it held roughly 411 million barrels. Now, 8 months later, it has fallen below 300 million. That is a decline that has happened almost entirely in the window of the current Middle East disruption. And it is the kind of arithmetic that the oil market, for all its sophistication, has quietly learned to ignore. The first thing to understand is that this is not an American story wearing American clothes. It is a global story whose most visible symptom happens to be measured in barrels under Texas and Louisiana. The International Energy Agency coordinates stockpiles across its member countries, the industrial nations that promise to hold emergency crude, precisely so a single government's reserves would not have to carry the world. In March of this year, those member nations did something they had never done at that scale. They agreed to release 400 million barrels in the largest coordinated emergency stock release in the agency's history. That is not a small event dressed up in big language. 400 million barrels represents a substantial fraction of the entire public emergency stock the industrial world holds, which by published estimates stood at over 1.2 billion barrels of government-owned crude, with another 600 million or so held as industry stocks that regulators can call upon in certain conditions. By July, the coordinated release had already drawn down close to 290 million barrels of that 400 million commitment. That is the context that the American number lives inside. The United States is not emptying a reserve in isolation. The entire emergency system of the developed world is being spent into a market that, by its pricing, is pretending nothing structural is happening. Here is the first layer of the story, the part visible in the data if you know where to look. The Strait of Hormuz normally carries around 20 million barrels of oil a day, something in the range of 1/5 of all the petroleum liquids the world consumes. Government energy data has pegged the strait's share at about 20% of global petroleum liquids for years, a figure so stable it has become background noise. What is not background noise is what has happened to that flow. The attacks of mid-August are only the latest in a campaign that has kept traffic through the strait running about a quarter below its normal level for weeks. 20% of global supply throttled by a quarter, sustained not for hours but for weeks and creeping toward months. The immediate gap between what the world wanted to consume and what could physically move through the choke point has been filled day after day, not by new production, but by the emergency stockpiles I just described. That is the mechanism the headlines keep skipping. The oil price did not scream towards some catastrophic number because the buffer did its job. It released barrels. And every released barrel is a barrel that is no longer there for the next disruption, the next escalation, or the moment when the market finally realizes that the buffer is not infinite. Now, layer 2, where the number starts to reveal mechanics that never show up in a headline. Stockpiles are frequently described as if they were production, as if releasing oil from a cavern were the same thing as pumping new crude from a well. It is not, and the difference is the entire story. A barrel of new production is a flow that can continue. A barrel released from storage is a stock that is consumed once and then gone. When a market is balancing a persistent shortfall by drawing down storage, it looks stable on the surface precisely because the drawdown is doing the stabilizing. The price holds, the panic recedes, the television anchors note that oil only rose a few percent and everyone moves on. But the equilibrium is borrowed. It is an equilibrium purchased with the strategic inheritance of 40 years, and it has a hard mechanical limit. This is what I think of as the depletion ledge. The depletion ledge is the point at which a strategic stockpile stops functioning as a shock absorber and becomes instead a signal in its own right. While the buffer is deep, a drawdown calms markets because it looks like the system has endless patience. As the buffer approaches its floor, the exact same act of drawing down begins to alarm markets because every release now visibly shortens the runway. The market's calm and the market's fear are produced by the same mechanism. The only thing that changes is how many barrels remain on the correct side of that ledge. A reserve 100 million barrels deep absorbs a shock and nobody notices the act of absorption. A reserve approaching only a few weeks of forward coverage absorbs the same shock, and every barrel withdrawn becomes a headline, a signal, a reason for the next buyer to bid higher. The American reserve passing below 300 million barrels to a level last touched in 1983 is not an arbitrary milestone. It is a measurement of how close the system is drifting toward the ledge. And the United States is the most visible reserve, but it is not the only one burning. The coordinated IEA release means Europe and Asia's government-held stocks are also thinning in the same window. The 1.2 billion barrels of public emergency stocks sounds enormous, and in a vacuum it is. But it was never designed to be spent at 400 million barrel increments, while a fifth of ocean-borne oil supply sits throttled. The arithmetic of the depletion ledge is straightforward. If the strait remains a quarter below normal and the shortfall keeps being papered over by releases, then the stockpile system is on a slide toward a level where the market will stop reading drawdowns as reassurance. The exact level is not knowable, but the direction is, and the speed is being understated by every piece of coverage that treats the current price as the verdict. The figure buried in a government table this week is the market's best warning system, and it is flashing amber while the commentary still reads calm and steady. At this point, a fair-minded viewer should push back, and I want to give the opposing case its full weight because it is not weak. The bearish and the complacent argument goes like this. Oil is only near $88 a barrel, up somewhat over the past month, but nowhere near the triple-digit panic that previous supply shocks produced. The reason, the argument continues, is that the world has real alternatives to the emergency stockpile. OPEC and its partners hold meaningful spare production capacity, something on the order of 3 million barrels a day in recent government and consultancy estimates, with the overwhelming share of it concentrated in Saudi Arabia and the Gulf states that are closest to the conflict. If the strait truly throttled supply, the argument runs that spare capacity could simply be turned on and high-cost barrels could fill the gap. On top of that, global demand growth has been sluggish. The electric vehicle transition and efficiency gains have shaved demand, and every single Middle East scare of the last 2 decades has eventually faded without the apocalypse the doomers predicted. That is the case for staying calm, and it has enough truth in it that it cannot be dismissed with a wave. The issue is that each pillar of that reassuring argument is quietly eroding in the very data that supports the depletion ledge. Start with spare capacity. It is real, but it is not static, and it is not sitting safely above the choke point. Consultancy forecasts published as recently as last autumn pointed to OPEC spare capacity shrinking toward 2 million barrels a day by autumn of this year, down from the more comfortable cushions of earlier years because the group has been running its taps to backfill exactly this kind of disruption. Spare capacity, like the strategic stockpile, is a stock of unused capability rather than a fresh flow, and it too is being drawn down. More damning still, spare capacity only helps if the problem is a shortage of willingness to pump. The problem here is a shortage in the ability to move cargoes through a narrow waterway. Around 20 million barrels a day normally transit Hormuz. The alternate pipelines and overland routes that exist in the region, the Saudi East-West line and the pipeline through the United Arab Emirates, collectively carry only a fraction of that capacity, and activating them at full pressure does not replace the missing 20 million. Saudi Arabia could open every available tap tomorrow and still be unable to deliver the oil to customers if the tanker passage remains constrained. Spare capacity that cannot reach the market is not spare capacity in any economic sense. The second pillar, weak demand, cuts the other way than the optimists think. Weak demand is what has made the drawdown survivable so far. But demand is seasonal, and the Northern Hemisphere winter, with its heating needs and refinery restocking, lands in the same window as the reserve approaching its floor. A cushion that barely holds in the quiet months is not a cushion at all in the peak months. And the third pillar, the history lesson that every scare fades, is true but incomplete. Every prior scare faded in part because the stockpiles and the spare capacity were deployed to buy time until it did. What history does not tell you is what happens when the scare outlasts the time you bought. We are measurably closer to that edge than the market's posture suggests. That brings us to the third layer, the threshold question, and this is where the number stops being an American inventory statistic and becomes something close to a global risk coefficient. A reserve crossing a psychological and operational floor does not operate in isolation. It interacts with other systems, and the interaction is what produces the danger. The first system is the physical one. With Hormuz still a quarter below normal, the market's daily balancing act depends on a shrinking stock of released barrels and a shrinking stock of spare capacity, moving toward each other from opposite directions. The second system is the financial one. The forward curve of Brent, with contracts out into the next year, trading at lower prices than the front month, has been held together by the belief that the current tightness is temporary and that the buffer will bridge the gap. Remove the buffer, and that belief has nothing left to stand on. The third system is the political one. Strategic reserves were built precisely so that a government could respond to a crisis without being forced into desperate choices. As the reserve thins, the range of choices narrows, and the probability of an escalatory decision, an escalating economic squeeze, a naval posture, a miscalculation rises for the simple reason that the cheap option is being spent away. The depletion ledge is therefore not only an oil story, it is the point where three independent systems, physical, financial, and political, all begin pulling in the same direction, and none of them knows the exact location of the drop. The buffer ends not with a bang, but with a bid, and the bid comes all at once. What makes all of this so dangerous to the complacent view is the asymmetry of information. The market is extremely good at pricing a known number. It is extremely bad at pricing the moment a number changes meaning. For weeks, traders have treated the stockpile draw as a routine data point in a weekly report, overlooked because the price stayed calm. But a stockpile has no opinion and no narrative. It simply declines. Every week that the Strait stays throttled, and every coordinated release that drains the IEA pool moves the system one notch closer to the ledge, and the market only reprices at the moment the realization becomes widespread. That is usually late, sudden, and violent. It is not a prediction of a specific date or a specific price. It is an observation about how systems that borrow stability from a falling buffer tend to unwind. The day the market wakes up to the depletion ledge will not be announced in advance. It will look, in retrospect, like a collection of warning signs that were visible to anyone who read the stockpile data instead of the headline price. There is a deeper cruelty in the current setup worth naming. Strategic stockpiles were created to give governments a substitute for panic. The entire value of a reserve is that its existence prevents the thing it is meant to respond to. In that sense, the reserve works even when it is never used because the knowledge of its depth deters hoarding and speculation and the cascading behavior that turns a disruption into a crisis. But the reserve only exerts that deterrent power while it is perceived as deep. Once it is visibly draining, the psychology inverts. A government holding a full reserve projects strength. A government drawing down a shrinking reserve with no credible dated plan to refill it projects the opposite. It tells the market and the adversary and the public that the buffer is the very thing being consumed. The depletion ledge, then, is not only an economic threshold, but a strategic one. The same barrels that buy a few more weeks of calm are simultaneously announcing to anyone watching the cavern levels, rather than the futures tape, that the calm is running on a timer. Weak hands in the real world of oil are not retail traders. They are governments running out of the stored firepower that lets them absorb another escalation. So let us return to the number the way the story demands. 298.7 million barrels and something under 300 million, the lowest American strategic reserve since 1983, falling by millions per week, while a fifth of the world's seaborne petroleum remains throttled at the Strait of Hormuz. When you first heard that number at the top, it sounded like an inventory data point, the kind of figure buried in a government table that only energy analysts bother to read. It sounded small against the enormous abstractions of global oil, a rounding error next to the charts of a market that trades tens of millions of barrels daily. But now the number means something entirely different. It is not a measure of what America has stored. It is a measure of how much disruption the world can still afford before the buffer stops buffering and starts screaming. It is a countdown disguised as a statistic, a timer wearing the costume of a weekly report. The attacks near the Strait of Hormuz did not create the most important number of this crisis. They simply accelerated the drawdown of the one number that decides how the rest of it ends. The market is still pricing the attacks. The attacks are already over, narratively speaking. The stockpile is not over. It is still falling, one release at a time, toward a ledge that no one has plotted but everyone eventually will feel.